Hello, it's Sam here from Keep Trust Planning, and in this short video I'm going to explain 5 ways that you can go about reducing or even eliminating your inheritance tax liability completely legally. But before I do that, if you could do me a favour and just click the subscribe button and the like button as well, so you'll get informed when I post videos up, which I'm intended to do quite regularly. So, inheritance tax, it's a thorny issue and one that causes a lot of concern and worry for people. But not everybody needs to worry about inheritance tax. In fact, everybody has an allowance of £325,000. Now, if you're married or in a civil partnership, you can combine those allowances to make a joint allowance of £650,000. Now, on top of that, there's something called the residential nil rate band, which is there to allow you to pass your property to your direct descendants, your children or your grandchildren. And that is £150,000 at the moment, but in a couple of months' time, in April 2020, that's going to increase to £175,000. And you can combine those two allowances together as well to give a joint allowance of £1 million once you combine that with the two initial inheritance tax nil rate bands. So if you have an estate of over £1 million, you do need to think very carefully about how to plan for inheritance tax. You should also consider how to plan for inheritance tax, even if you're below £1 million, because we need to make sure that your assets pass in the best way possible in order to allow you to use those allowances to your fullest advantage. So my first top tip is to write a will. So as I mentioned, you need to write that will so that your assets pass in the best way possible so that it maximizes your allowances. Passing the assets for the benefit of your spouse is the number one thing that you should be doing, because spousal exemptions are inheritance tax free. So on first death, if you pass assets to your spouse or for the benefit of your spouse, then you're going to avoid any unexpected inheritance tax bills on first death. In order to make sure that we claim the residential nil rate band, we also need to make sure that the property passes eventually to the children. So the important thing is to get that will written and to get professional help writing it, because it does need to be constructed in an inheritance tax efficient way. Now, my second top tip is to give assets away. You can make gifts while you're still alive of up to £3,000 a year, and that amount of money will be out of your estate immediately. If you're married, you have 2 allowances, so it's a combined allowance there of £6,000. And anything over that amount will be considered to be outside of your estate for inheritance tax after 7 years. This is known as the 7-year rule, and it means that anything that you gift above your allowances comes out of your estate after 7 years. And it's actually a sliding scale, so you do begin to get advantages almost straight away. You can also make gifts to your children on the occasion of their wedding of up to £5,000. So that's another little bonus for you in order to reduce your inheritance tax by that just a little bit more. Now, you do need to be very careful of something called gift with reservation of benefit. Sorry, I'll start again. Gift with reservation of benefit means that you pass an asset to somebody else or into a trust, but you continue to retain the benefit of that asset. In other words, if you gave your house away but continued to live in it rent-free, then the house would not come out of your estate as far as inheritance tax is concerned, and it would be treated by the Inland Revenue as though that had not happened, that disposal had not been made. So when we gift something, we need to make sure that we no longer take any benefit from it. And again, it's very important that before you start gifting, that you do take that professional advice. My third tip is to make gifts out of surplus income. Now, this is a little known inheritance tax planning trick and one that isn't utilised that often. But essentially what it means is that if you make gifts of money out of income that is surplus to your requirements, that can be treated as a gift that is not included for inheritance tax purposes. Now, let me give you an example. So let's say you have an income of £100,000 a year. And with that income, you are able to go on holiday and pay your bills, pay your mortgage or your rent, and live a certain standard of lifestyle continually. But your income of £100,000 is more than enough to sustain that income, and you only spend, let's say, £60,000. That extra £40,000 that you don't spend can be gifted, provided it does not impact on your standard of living and the quality of life that you've enjoyed up till now. My fourth top tip is to put assets into trust and retain the income. Now, you may be able to put some of your assets into a trust depending on what type of asset it is. And again, I would encourage you to get some financial advice and speak to a financial planner or an independent financial advisor to find out exactly what you can put in trust. But the principle remains that you can put assets into trust, you can retain the income, you can take the income from the trust, although you would be signing away your right to ownership of the asset that you put into trust. So essentially you're kissing goodbye to the asset, but retaining any income that that asset generates for you. Now, my fifth top tip is probably the most fun, and that's simply to spend it. It is, after all, your money, and if you're lucky enough to have built up a estate that qualifies for inheritance tax, then the best way probably to reduce that inheritance tax liability is to go out and enjoy yourself, go on holidays, have cruises, and just get that inheritance tax liability down by disposing of your income or your assets through expenditure. Now, again, I've said this before and I must reiterate it again. All of these plans should be taken after consultation with a professional estate planner like myself or an independent financial advisor. But this video is made for information purposes only, so that you can understand the basic ways that people can go about planning for inheritance tax. Now, I really hope you enjoyed the video, and I'd love it if you would to subscribe to my channel. It's a channel that I've created to share information on how to protect your assets moving forward, inheritance tax, protection of assets from other threats like care costs, for example. You'll find it all on this channel. So please do join my community, click the subscribe button and the like button, and I look forward to seeing you very soon.